So I usually use this this DCF. Come on. This DCF model on these live streams to do a quick calculation of a company's stock. But I can I'll just kind of pick it apart and show you how to build it yourself if you wanted to. It's pretty simple. This is pretty straightforward. It can get more complicated, but this is pretty much does the job for DCF. It's exactly what you want, and it's pretty straightforward. It's just really a simple calculation of DCF. There are some other things in it to make it a little more confusing, but I'll just show you how you can recreate this yourself. Let me just make the screen. So so the first part, well, maybe I'll add the formula back in. Okay. So the first part is the market cap. So that's, you would just get that. You would search a ticker, whatever ticker you wanted to do a DCF on. I don't know. Maybe we should just, I guess we'll just use a ticker, a current ticker out there. What's a good ticker to do a DCF on? I guess Microsoft is fine. Okay, so 3082. Three 082 121212. Okay, so all the numbers are in millions. So that's why it says 3,000, because 3,000 times a million is 3 trillion. So that's their market cap. And to get the shares outstanding, I just do a calculation. So we'll do a stock price. The stock price is 415. Doesn't matter if you round it. Let's see. Maybe I'll make the okay, 415. Okay. So I'll just make it green, the one we're doing. So it's, let me put a line here to separate. That's not good color. That's good. Okay, so we'll do Microsoft. I'll show you kind of how to build your own DCF. Okay, so that's the market cap, 3,082, because it's in millions. Stock price 415. Shares outstanding. It's just market cap divided by stock price. So it's 7 million shares outstanding for Microsoft. And then you need some other information. So you need the obviously you need the future cash flows. So that's the whole point of a DCF, is you need to project what the future cash flows will be, and then discount those back to today's dollars. Let's just put it here. And you can just use simply Wall Street. I'm sure there's other websites. Asmin, what's up? I thought this would be a good topic. Maybe not. So to get future cash flows, Simply Wall Street actually lists the analyst projections for most companies. So for 2024, yeah, I'm kind of just showing you how to build it. It's pretty, I think it's pretty straightforward. Just a DCF, just present, you have to predict the future cash flows for a company or an asset, and then discount those back to today's dollars. I mean, the way to think about it is, like if I say, give me $1,000 at the end of the year, then next year at the end of 2025, give me 1,000, and at the end of 2026, give me 1,000. So what is that worth in today's dollars? Oh, real estate. Oh yeah, thanks for watching that. Yeah, I'm trying to get more into commercial real estate. I just started working for a real estate developer, so I want to just learn more about the industry. So how much would I have to pay in order to receive? Let me put the dates. If you understand how bonds work, a DCF is, I think, pretty straightforward. So this is an investment. Somebody said they're going to offer you $1,000 at the end of this year, and they'll give you another $1,000 at the end of 2025, and another $1,000 at the end of 2026. So how much is the investment? Well, if they said, well, it's $3,000, that's the investment. That's what you have to give me. And then you would not do it, because why would you? You're not getting anything. Because even if you put it into even if you got 1%, even if you got 1% interest, which isn't a lot of money, 1%. I'm not going to do compounding. I'm just going to. Even if you put it into like a savings account, a really low interest savings account at 1%, you would end up with $3,090 after 3 years. So obviously you wouldn't invest $3,000 with this company, because in the most safe investment, you would beat that. So you'd have to give something less than $3,000. So then you have to figure out, if he said, give me $2,800, and I'll guarantee I'll give you $1,000 over the next 3 years, then there's something to think about. You might not still do it. It has to be the right Yeah, I don't know when I'm going to hit 40K. It's going to be like another year, it seems. It just takes, I haven't been adding subs that quickly. So that's kind of like a DCF. How much money are you willing to put into a stock? Microsoft is $415 a share. So you're going to give $415 to Microsoft. Not really, but you're investing $415 with this asset. That's a huge company. And what do you get in return? Well, you have to, obviously, when you invest in a stock, you don't really get paid anything, except if you do get a dividend, of course, which they do pay. But if you invest in a company with no dividend, you don't receive anything. The goal is the stock will go up, and then you could sell it, of course, and you hope it goes up a lot. So I'll show you an easier way. If you don't have Simply Wall Street, you might not pay for Simply Wall Street. You can just go to Yahoo Finance. It's free. And you could look at their free cash flow and try to estimate the future. So you can see that it was 71 billion, their free cash flow in the trailing 12 months, which is a big jump from 59 billion. So let's just say we use that. Okay, let me put that. So you don't have to even pay anything. You can just okay. I knew something was wrong. I didn't have the right market cap. I had 3 billion market cap. It's 3 trillion. Okay, that makes sense. You reverse engineered. That's the way to do it. I reverse engineered a bunch of DCFs. That's how I started the channel. It was mainly one guy's video that motivated me to do it. That Jimmy, I think, he has like 200,000-300,000 subs. He did a DCF video, and I wanted to know how to do it. So I just kind of copied his, and then I started making videos, and then just evolved. Okay, so if you want to just go to Yahoo Finance, and I'll show you how to change the numbers. Let's just keep it simple to start. So according to Yahoo Finance, and Yahoo Finance is correct like 99% of the time, so you don't have to worry about that. Their free cash flow is 71 billion. This is for the trailing 12 months. So this includes it's, I'll put it right here. It's 4/1/23. So this is for the time frame. Not that you need this. I'll probably, but I'm happy to share or talk about it. I'm not like I'm trying to hide anything. But it's, yeah. That's the best way to learn, is to kind of like trial and error and just keep plugging away. it's kind of like when you learn how to play like a sport, you have to just make a lot of mistakes and screw up. And sometimes you spend months and months not progressing, but eventually it kind of clicks. Okay, so I'll just I'm just kind of adding things now, which I wasn't expecting to do, but okay, let's do a 5%, which is probably kind of low, but now I'm probably making it more difficult than it needs to be. So everybody's probably getting confused now. Yeah, maybe I'm not good at explaining this. I feel like, okay, so if I use their most recent free cash flow of 70 billion, and then I'm so stupid. I should have prepared better for this. Okay. I'm like, why is it small? I added, okay. I guess I'll just set it up, the model, and then maybe it'll be easier once I set it up. So I just grew their free cash flow by 5%. So I added 5% to that 70 billion. I'm going to do the same thing for year 2. Add 5%, and then year 3, 5%. And we could change the percentage later. I'm just getting it set up. Happy Mother's Day if you're a mother. So here's the free cash flow projection. And I can email you this if you want, or I could put it on my Patreon. Okay, so the free cash flow projection it is you can go out, like, you can just project 1 year into the future. You can project 10 years into the future. Most people do 3 to 5 years. But if you want to go further out, you can. The terminal value is all cash flows after your final year of projection. So all cash flows after year 3. So this formula, in order to do it, you need 2 more numbers. You need the terminal growth. And the terminal value is very similar to the dividend discount model or the Gordon growth model, if you wanted to search those terms and learn about them. So generally, the growth in perpetuity, the terminal growth, you don't want it to be more than inflation. Usually I use 2.5% in my videos, but because I'll explain a little later why. And the WACC, there's a website called Finbox, and it's free. I don't pay for it. I think if you want to, there's more features on Finbox you have to pay for, but what I just need the WACC, and it's free. So you can just search, go to Finbox, search the ticker, go to models, cost of capital, and this is the WACC. So you can use a blended WACC, or you can use their low WACC or middle WACC. So sometimes I start with the low and then kind of adjust it, maybe to the medium. So the terminal formula, so the first thing is you take your most recent cash flow, which would be, in my case, year 3, 81 billion. Then you multiply it by 1 plus your growth rate. I put 2.5%, and we could change the numbers. And when we change the numbers, you'll see how the numbers will change. Then you divide it by, and we could pick apart any of these formulas, and it makes a lot of sense once you understand it. But now you might not understand the exact reason these numbers, but you can just memorize the formula to start and then eventually dig into it. Then divide it by the WACC, which is this company's, every company has their own WACC, and it's usually between 7 and 12%, but that's how much it costs this company, Microsoft, to obtain capital, 8%, minus the growth rate. So it's 1.5 trillion. Maybe I should put this over here. I guess it. I'll put a footnote here. It's the latest free cash flow times 1 plus your growth rate over WACC minus growth rate. So that's a terminal value. So based on this, let me put it over here. Okay. So now we have to discount the cash flows, because these are real dollars based on sometime in the future. So 3 years from now, we project their free cash flow to be 82 billion. But we need to know what 82 billion is in today's dollars in order to make this to work. So we have to discount all these numbers. D3 or D4. Oh, it's hidden. And you have to discount it by the WACC. I'm just going to put numbers here so I can use that formula. discount. So I'll show you the formula as I'm writing it. So the formula is to discount. I'm assuming 1 year from now, Microsoft's free cash will be 74 billion 1 year from now. So we have to discount just 1 year. Equals this is just a discount rate, not how much 74 billion will be. Equals 1 plus the WACC raised to the first power. So it's 1.08 because you're not discounting this much. I'm going to freeze C20. And in 2 years, it's 1.08 raised to the second power because you discount it more. Because as you go further and further into the future, those funds have to be discounted a lot more. Because if somebody said, I'll give you $100 in January 2025, and then they say you just have to give me $90, so you're out $90. But your friend said, just give me the 90. I really need the money, and I'll give you $100 in January 2025. And you think that's a really good deal. It's a great return. Less than a year from now, and I get like an 11% return. So it's a great deal. But what if he said, give me $90 and I'll give you $100 in 2035? Then you're like, that's actually not that good. Why would I do that? My rate is, I'm getting probably like maybe a 1% return, and I have to wait 10 years. So it's the same thing with this. The further you go out, the more you have to discount it to take into account the time value of money. So PV. Or free cash flows. So the present value I guess it's hard to really do this in a simplified way. There's so many steps to it. So if you were to receive $74 billion in 1 year, that's equivalent to $68 billion today. Because we're using an 8% discount rate. That's Microsoft's personal discount rate. And $82 billion in 3 years is equivalent to $65 billion today. So you see 82 billion is less than 74 billion. So this is kind of like a question in math class. Would you rather have $74 billion 1 year from now or $82 billion 3 years from now? If you were Microsoft, you would definitely want 74 billion because it's you get more money in today's dollars. And that's how you have to look at everything in today's dollars, because you're trying to make everything equal. And then the terminal value is 1.2 trillion. The discount rate used for the terminal value is the same as year 3. $74 billion now. What it? Okay. So the value of MSFT so based on our analysis, we think the value of Microsoft is $1.4 trillion. That's what they're worth today. But let's convert that to a share price. Stock price, our calculated stock price, which we can do now because it's just 1.4 trillion divided by the number of shares outstanding, which we already calculated from the beginning. No, I got that, Jason. I knew what you meant. So we're saying Microsoft is worth $190 today, even though it's trading for $415. Let me just update this if C22. So I didn't prep for this. I'm doing it on the fly. C15. I'm at. I'm just not going to do this because I have to keep playing with this formula. Okay. I should prepare better for these things. I just kind of do it. Okay, so there it is. Did I miss anything? So this is kind of a rudimentary DCF, but it gives you what you need, the tools. Let's just look at simply Wall Street to see if what the analysts project. See, analysts got 69 billion, 78, 95. So they're 95 billion in year 3. So why would Microsoft be trading at 415 if the DCF is 190? Well, because first of all, I just grew their current free cash flows 5%. Right? Which is they're Microsoft, and we're right in the middle of the AI boom. So they might actually grow a lot more than 5%. That's why people are buying the stock now, even though it's not worth $415. They're buying it because they think Microsoft will take advantage of AI. So maybe 5% is too low. Maybe 15% is more appropriate. And that looks a little more in line with the analysts' expectations. But it's still pretty overvalued. And a stock may never come down to its true valuation until it goes. I mean, it seems like some stocks they get closer, but some stocks just always seem overvalued, and some stocks always seem undervalued. So it's not like if it's always undervalued, you're never going to make money. It's never going to 2-3x, even if the model says it. It's just market sentiment. So you have to kind of find those, and that's what I'm still trying to do. Warren Buffett's somehow figured it all out, but you have to somehow find those diamonds in the rough that are undervalued that will actually come back up. And a lot of stocks, like Tesla, was so overvalued for so long, and the idea was they were going to grow into it. And they did grow a lot, but they never grew enough to become worth $1 trillion company. They're kind of getting a little more stable, where they're profitable and the numbers are getting consistent, but they're around the 400 or 500 billion market cap point. And until something really changes with them. But this is based off of just our assumptions, and we're using analyst assumptions. So maybe that 8% is not appropriate for them. Maybe we should do 7%. And there you go. Now it's $300 a share. Or maybe, I mean, there's not much you can play with. It's you could lower the WACC to raise the price. You can change your cash flow estimates. The terminal value, we already kind of maxed out the terminal value. You don't really want to go over 2.5%, because the idea of the terminal value is the growth forever. And it's not like in 100 years from now. I'll show you how it doesn't really affect. Because you might say, well, they're not going to be around. What if they're gone in 20 years? Why am I going to have them grow forever? But I'll just show you how it's kind of irrelevant. These are good exercises to do to understand it better. Okay, this is good. Let's go back to 8. This is 24, 25, 26. So 2027. Actually, what happened? Oh, 1-1. So that's the free cash flow estimate for 2027. I'll show you how to come up with the 2 trillion on the long approach. Did the wrong one. Stupid. Okay. hell? God. What's going on? Why is it... It's annoying because it's usually it's a lot faster when I'm in Excel doing this stuff. It's real fast to calculate, but on a live stream, like when I try to change something, it takes like 2 seconds, and it feels like it takes forever because I usually when I hit the calculate, it does it within a fraction of a second. So everything's so fast and automated, but on the live stream, it kind of drags down your computer, so it's just slowing things down. And when I make a mistake, like I was referencing the wrong cell, I have to like wait 2 seconds, then change it. Okay, so this is the free cash flow and the discounted free cash flow. See, look how much it brings it down. This is probably taking longer than I. 1 plus. This is, you don't need to do this for your DCF. I'm just showing you how terminal value works. I think I did it wrong. I'm so stupid. I did the. I'm like, why do they have the same discounted? Because I use 2.5% as my discount, not 8%. Here we go. Now we can finally drag it down. Okay. No, I love Excel. And look, I'm using Excel. That's why they're so rich, right? Microsoft Excel. We'll go out 200 years. Let's go out another 100 years. Oh. Okay. So eventually it's nothing. If you go so far out into the future, even $1 trillion is worth nothing. So how come it's not 2 trillion? I thought it'd be 2 trillion. No, well, it should be. Did I do something wrong? Was it because of the first one? Okay, so can you upload the sheet to local drive and share a link? Yeah, sure. Okay, 1 plus. Oh, I didn't even do the right. Okay. The next time I do it, it'll be a lot more straightforward. You can email me if you want. The financial.business.consultant. I don't know that. I guess I don't have to explain, or not. Well, I could explain terminal value. I guess I don't have to back into the calculation. I thought this would terminal value 1 plus C19 divided by WACC minus growth. So I'm just trying to show you what I'm trying to do, which you don't really need to do, is how with the terminal value, it's projecting your cash flows into perpetuity. But once you get beyond a certain point, like 20 years, and apply the discount rate, even though like in 2050, right, we project Microsoft's free cash flow will be 194 billion if they grow at a 2.5% rate. But when you discount that, it comes down to 26 billion. So the discounting really drags down the numbers. So once you get it to a certain point, if you say Microsoft might not even be a business in 2080, but it's so insignificant, the amount of like this 2 trillion. This is mostly the first 20, 30 years. After that, it's so small because of discounting. Because we're discounting based off of the WACC. If that makes sense. So that's all I was trying to convey. Like, of this 2 trillion, come on. I just summed up the first 25 rows. So most of that 2 trillion is right in the beginning. So I'm saying terminal value, even if you only assume that they would be around for 30 years, it would probably be a similar result as assuming perpetuity, because after like a certain point, it gets so small, the future free cash flows, it eventually becomes zero, because your discount rate, the WACC, is higher than your the 2.5%. But yeah, so this is how you would play with it. You would get this model, and then say for instance, this is how analysts do it when they update their price targets. Say for instance, this is your kind of like 2024, like full year 2024 estimate. This is 2025, 2026. Like say for instance, in 2024, like we think they would have 81 billion of free cash flow. But let's say they actually did much better. They started to get a lot more sales in AI or whatever, and then it ended up being 97 billion. Then you would update your model with actuals, and now their future growth is stronger. So now your target goes up to 300. So it's getting closer to the 415. And eventually, if the market's perfect, eventually your target should be really close to where they're trading at. But you don't want to wait. You don't want to wait 2, 3, 4 years. You want to buy it now and make some money. You don't want to wait for everybody else to like figure it out. Or if the opposite happens, they report in 2024, they totally missed. They actually hit 64 billion instead of your 81 billion. So now your target goes down to 200 from whatever it was. Okay, I had a feeling this would be a rough video to kind of do. Let's just look at companies. It's probably easier to people to absorb and digest. But look, I have this new, I'll be right back. Okay, I'll be right back. So let's just put into practice, I guess. Is there any tickers? Anybody wants me to do on my DCF here? Maybe that you saw building the DCF. When I actually plug it in, it might actually click more. Let me know if there's any tickers anybody could think of. But I think TNK. I think Oh, TK Tankers. I think Yahoo Finance may have analyst projections for future. Yeah, so they do have earnings estimates in Yahoo Finance, analyst earning estimates for 2024 and 2025, revenue estimates, earnings estimates, EPS. So this is so there are some companies that have negative free cash flow. So in order to calculate the future free cash flow, you need to use the revenue and assume they would have positive free cash flow at some point in the future. That's generally how we do it. So you could do it on any company. It's just a little harder. $69. They do. Was checking it out. Never knew Yahoo had this much information. You be like, when people say like, what tools do you use? Some people spend a lot of money, and I actually prefer Yahoo Finance over any other paid service. And the only reason I pay for Simply Wall Street is because I do videos, and it just adds to the videos. But I normally wouldn't pay for it. Yeah. So marine shipping stocks tend to be a bit volatile. They're really dependent on the rates these companies charge to move product. And usually the rates are determined by the supply of ships in the market. So when the supply of ships gets really high, then it's then the rates go down and these companies start losing a lot of money. But when the supply of ships goes down, like some companies go out of business, or after a certain number of years, like 20 years, you have to scrap the vessel. So once there's less vessels in the market, then demand starts going back up. TNK. I mean, there's ways to kind of try to predict this stuff. It's hard. There are different indexes. Do you know the indexes, Jason? Shit, I can't remember the names. I wrote it down somewhere. Oh, the Baltic Dry Index. Depending on what the shipping company transports, they have different indexes. The Baltic Dry Index, which is the price for a number of routes to move cargo. And you could see, like, in 2021, like when Zim came out, it was making so much money because rates were so high. And then Zim crashed like every other shipping stock, or struggled. But it did come up in the beginning of 2024, but now it's coming back down. So it's hard to predict these things. 524 million. I think that's a pretty low whack. I'm going to raise it a lot. And I'll drop the terminal value. I have an FX rate here in case I do foreign stocks that trade in the US. So I can just change the FX rate to convert all the financials to US dollars. So even I tried to make it more aggressive, the model. I guess aggressive means I'm trying to lower the predicted stock price. Conservative means I'm raising the stock price. Because I think there's a lot of headwinds in this industry, no pun intended. So it's just it's a tough market to turn a profit. But it seems really undervalued, but that doesn't mean it's a buy. If shipping rates rebound, it will do really well. But if they stay stagnant, wow, look, they really came up a lot recently. They must have had earnings recently, right? Is that why it jumped up so much? A TSI, I never heard of that one. They really rebounded in the past year. They've doubled, more than doubled. They've done, wow, that's pretty good. Well, you see, it does correlate to maybe it doesn't correlate. They really shot up from January 2023 to current. It's up like 120%. The Baltic Dry Index also did well, but it's come down. This stock hasn't come down, but there's usually a lag. But this totally doesn't match at all. Yeah, it looks pretty good. It's done really well. I wonder where let's see compared to Zim. Oh, look at Zim. Just shot down. Zim might not be the best comparison. So in the past year, Zim is up 65%. This is up 38%. Zim is much more volatile. You can see the ups and downs are much more severe. Well, Zim really has done really well the past 3 months. I think I did a video on TK. Okay, so they provide crude oil and other marine transportation services to oil industries in Bermuda and internationally. So they're an oil tanker. Zim moves like dry product, like coal and grain. It's a kind of a different animal. TSI freight. Oh, TSI, you said, right? Is that I was hoping it would be TSI shipping quotes. Do they have any like charts? I'm trying to find a chart like to see the shipping rates over the past few years. Freight transportation. Okay. I mean, I wish it's a year old, this chart, but. This is only from March 2020. It's probably not good. Quags, what's up? There you go, Fred Data. This is this is a government website. The freight transportation services based on a freight carried for hire. I didn't get a notification. Yeah, sometimes that happens. I don't know how they do it, but yeah, TK. I don't know. So any other tickers we can run a DCF on? There's one YouTuber that does a really good job on shipping companies. That's all he talks about. Forgot his name. TKR. The ticker. Damn it. TKR. That's a good ticker, TKR. Because it's, if you had to like shorten ticker, you might do TKR. $9.3. And if you use Yahoo Finance to get the future free cash flows, you can use the future revenue and then calculate the free cash flow based off of future revenue. To calculate it, you just look at their past revenue and past free cash flow. Or you can use the industry average. $430, 500, 6. $9.3. Timken. Did I do a video on Timken? It sounds familiar. Did we talk about this before, Timken? I kind of remember Timken, a manufacturer of bearings and power transmission products. They're a pretty 4.8 billion of revenue, pretty big company. Let's raise the whack a little. So yeah, so it seems slightly undervalued, but sometimes small caps will stay undervalued for a long time, while large caps will stay overvalued for a long time. Because it's kind of like marketing. People just don't know about a lot of smaller cap stocks. Where large cap stocks, even if the company's not doing well, people buy the stock. They just, like, remember AMC or GameStop, people just bought it who didn't know anything about investing, thinking it's a good investment, and then they lose most of their money and they never invest again. Okay, they're from St. Louis, Missouri, your family, or Canton, Ohio. They've been around a long time, since the date. So they've been operating in 3 centuries, 3 separate centuries: the 1800s, 1900s, and 2000s. Timken posted $4.8 billion in sales in 2023, employs 90,000 people globally. The most responsible companies in America's greatest workplaces by diversity. Canton. Yeah. This is like what Buffett does. He finds these companies before everybody else does. I don't know how he does it. Net sales. So sometimes I like the investor presentation. It's kind of like a user-friendly version of the SEC filings, because a lot of the information is here, but it's just colors, and sometimes it's a little easier to read and they present it nicer. I mean, the very first picture was a semiconductor chip. Is that I know they do bearings, but for what industries? Is it just I guess for all industries, or are they specialty? It doesn't seem like they're specialized. They have a lot of sales. So first quarter sales were down from 6%, last year's record level. I wonder the stock drop, because the stocks usually drop if there's a decline in any type of fashion. No, it went up. So this is the kind of stock that hasn't been really doing much for a while. Look how high it got, and then it came down, then it went up. Usually when you look at like really good companies, it's just like almost a straight line. You know, there's ups and downs. So this, yeah, bearings. And then with you know, the technology AI boom, you would think this could be an opportunity for this company. They also own Timken Steel. They directly found that. So it might move with steel prices. Is there an ETF for steel? Yeah, we did CVS yesterday. That was seems like a good value. EBITDA 21%. Paid 407th consecutive quarterly dividend. That's a lot. That's like 40 years of dividends. Organic growth. So yeah, so they're involved in all these industries, automation, rail services. Yeah, so they probably have a pretty wide reach. Yeah, I don't know. CVS is just such a... It really hasn't done that great, right? It's really come down. It was over 100 just 2 years ago. So it's down 50%. It was even higher in 2015. Imagine it buying up here. That'd be a nightmare. After 9 years, it's got to rebound. I mean, just in a month, it's down like, what, 30%? It's got to rebound. It's too big of a... CVS, I think they're like 2/3 retail, 1/3 insurance. Is it Aetna? Do they own Aetna? Is that the... Yeah, Aetna. Okay, yeah. So they own Aetna. They got them in 2018. So 1/3 of the business is insurance. I think about that. And 2/3 the retail. So they're a giant. I mean, they have a lot of revenue. I think they're like 10th largest revenue generator in the world. Yeah, but you would think it's got a rebound, right? But that would have been terrible if you got it. Because I could see like somebody watching one of my videos and I'm like, oh, it was trading at 106 and now it's trading at 80. It's a great time to get in. And now it's down to 55. So the thing is now the good time or will it hit 40? But I felt like with Netflix, I mean, we've all done that, but I wanted to get into Netflix. I was going to buy them back in 2012, and I didn't pull the trigger. And then it almost hit 700. And then I got it at 380 because when it dropped real fast, it was like October. In 3 months, it was down 50%. I'm like, okay, this seems like the bottom. And then 2 months later, I was down 50% on my investment. But I mean, I guess I could have dollar cost averaged, but you just don't know when the bottom is. Now I'm up 60%, so I'm okay. It's just like for CVS, where's the bottom? Who knows, right? But it's got to be a good time to buy, right? It seems like it, right? Oh wait. I just did a video. So I'm at 130, and I think it would have been like 160 my calculation, but I lowered it. I can't remember how I lowered it. I think I lowered the estimates, maybe. I can't remember, but they were almost 16 billion of free cash flow in 2021, and the forecast is still their 2026 forecast is still lower than 2022 and 2023. So it's yeah, I think it seems like a good time, but it's so easy to buy a stock when it's going up. You always feel confident when a stock went up. You always feel like this is a great company, but when it goes down, you feel like this is not a good company, and it's going to keep going down. We always do the opposite. We love investing in stocks that are at all-time highs, but we hate investing in stocks that are at all-time lows. Yeah, I think it's a good time, but I'm not sure if I'm going to put my money where my mouth is. I guess I could sell. Yeah, I felt the same with Disney, and it's going okay. I got Disney at 80. Let's see, when did I buy Disney? At 86. I got it right here in August. No, that's 22. I got it at 86 right here, August 2023. I was up a lot more 2 months ago, but I'm still up. So I'm okay. But I just felt Disney at 80 at that price. It just seemed a little too low. Their the all-time high was 2021, but when they were in the 80s, it was trading at a 10-year low. Okay, it was 10-year low. It wasn't as bad as I thought. Was it AT&T was like a 20-year low? But I'll admit, I mean, I did get a little lucky in the timing. I mean, of course, I could have got it a little lower, but I got lucky in the timing. But who knows? It might be $60 by the end of the year. I mean, it's just like Netflix. I didn't time it right, but it worked out. I think the best timing was new. When I got it at like under $4. But it's just if I happen to have money to invest, it's just that's the time I invest it. If I have extra cash to invest, it's not like I usually don't sit and wait for a stock to go down. Although Disney, I wasn't waiting on it, but it got so low, I ended up selling out of something else to buy Disney. I think I sold my Intel to buy Disney. I remember somebody saying, I got Intel for like, what was that? I'm going to say 40, maybe. And then I ended up getting rid of it. Well, I guess August 2023, right? To buy Disney. So it went from like 45 to 35, something like that. And then somebody's like, when it broke the 50, somebody said, do you regret selling Intel? And I said, not really, because I didn't sell Meta to buy something else. If I sold Meta, I would have lost that 200% gain. But look at Intel now. I'm glad I sold it at 35. Now it's at 30. AT&T is a zombie corporation. They get sued every quarter. I'd rather buy CCI versus AT&T. The REIT, Crown Castle. I was thinking you meant the Carnival when you said CCI. We're both down a lot in 2 years. Well, CCI really came down a lot. It's down 44% in 2 years. I just kind of I like Intel. Well, I liked it, but I just lost faith in the company. I just didn't really feel good about the future. So I just wanted to let it go and not deal with it. I'm holding I'm a bag holder on other things, so I don't need to be a bag holder on. Seller is just awful. Sheesh, it's done terrible. Look how high it was. It was almost $60. I kept dollar cost averaging on this company. What a waste. They got no revenue anymore. Are they going to go bankrupt? Accelera. And they're in bad shape. It was a risky one. I just gambling a little. But it's still $1 billion market cap. It's not like a small company. It's not like, I mean, it was 20 billion. Mark. Yeah, 20 billion. another REIT. These REITs have been really kind of struggling. Well, it depends what market you're in. Well, look how high it was at IPO. Yeah, this is. $71 billion. That's a big company. $71 billion. $8 billion revenue. Equinix. Redwood City. It's right here in the Bay Area. Internet connection, data centers. It's a big market. It's a leader in global connection centers. Do they work with like NVIDIA and data centers? So yeah, data center. So what do you guys think of Equinix? Let's see what they say about the company. Earnings presentation. Revenue, it's not growing much. Adjusted funds from operations. That's how usually you compare REITs from FFO. Adjusted just. So FFO equals net income plus depreciation minus the gain on sale of real estate. It's similar to EBITDA or operating cash flow. Yeah, okay, I wrote it correctly. Sometimes. The reason REITs use FFO and not EBITDA or operating cash flow is because they tend to have a lot of real estate. So if they happen to sell one of their properties in a quarter, it could overinflate like the operating cash flow, for instance. And most businesses aren't to sell assets, is to kind of operate the business. So you just want to kind of like eliminate those big fluctuations. (2.25%). If you want a nice dividend, invest in a midstream stock like Energy Transfer or MPLX. Cash, gross profit. Debt maturity profile. That's the problem with REITs is they have to take on so much debt because they have to give out most of their earnings back to the investors. They have to give like 90% of their earnings back to investors as a dividend. So it's hard to grow and scale when you have to give back all your money. $243 data centers. They've been growing their dividend. Here's the payout ratio. It's about 50%. Looks good. I don't know. I don't really know too much about this company. It's hard to say if I would pick them over DRL. Strive, U.S. Energy, and yeah. DRL. Huh. I don't see that ticker. But okay. Well, thanks for joining the live stream. Let me know if you have questions about how to look at the DCF. That's what I did in the beginning. Digital Realty. Okay, that's it. Yeah, I'm more familiar with Digital Realty. But yeah, I'll think about it. I'll try to let you know next stream. Okay, yeah, I gotta finish editing these videos. Thanks for watching and tuning in. I'll talk to you later. Hey, Alex.